Yada.
Does it work? No. Yeah, it works. Okay. Hi, welcome everybody. I'm so thrilled to see so many people coming out to learn about taxes, right? Yeah, because they're so exciting. No, but seriously, I think that without question. This is an area that the changes do particularly affect our community, right? The community of artists. And so I think it's so important and wonderful that the Actors Fund and the SAG-AFTRA Foundation have partnered up to make sure that we all have the information that we need to be as prepared and as powerful as possible, right? So I have a fancy clicker. I'm very excited about this. Okay, so I first want to just establish today's objectives before I bring up our panelists, okay? The thing that I think is the most important for you to, I love the music, right? No, it's all right. Makes me want to dance. Okay, awesome. So I think that one of the most important things for you to recognize is that you are the leader of your financial team. Does that make sense? There is absolutely no one who cares more about your money than you do, right? And so the reason that I say that is that I don't think that we all have to be experts. I think it's important to have experts on our team. But I do think that we have to have enough information that we can be a part of the conversation, that we know what questions to ask of the experts that are in our lives, okay? And so the purpose of today is to really, first of all, help you make sure you understand the fundamentals of what goes on your tax return, and also that you really understand what the primary changes are to the tax law so that you can be armed with the questions you need to ask your own tax professional, all right? And that's the important piece here, is that none of us, me nor the guests that I'm about to introduce, we do not know your specific situation. And I can guarantee to you that if there are 120 people in this audience, there are 120 different situations, okay? So please don't take any of what we're saying as this is absolutely what you should do or not do, right? The key here is that you leave with the information you need to get the questions answered that you specifically need to have answered. Fair? Okay, perfect. So I am first going to introduce Emily Churchill. If you'll come on up. Thank you. And I'm going to give both Emily and Ronnie a chance to introduce themselves in a second. But let's bring up Ronnie Stedman.
Yay, Ronnie.
Thank you guys so much. I'm really, really grateful to you both for volunteering your time to be here with us. And will you go ahead and, Emily, first, will you tell us a little bit about you and what brought you to start helping people prepare taxes?
Oh, that's fun. Well, I am an actor too, so I get you. You guys. I have a marketing degree. What? And so I like numbers. And when I moved here a while ago, somebody came up to me, Ernie Charles, actually, I don't know if he's watching, and he was like, do you want to possibly do taxes? And I was like, sure. I had no idea what that meant. And so I took some courses, and I got CTEC certified. Do you remember that? Before we were EAs. It was before enrolled agents.
Go CTEC.
Go CTEC. Now, CTEC is a certification that in the state of California, you have to be CTEC certified to prepare tax returns. And so I took my classes, took my tests, got CTEC certified, and so I was doing taxes for about 2 or 3 years. And I realized that I couldn't, fully represent my clients in front of the IRS without getting my enrolled agent license. And so I went to UCLA and took all the classes I needed to there and took the, 3 really hard test and the laws and everything of taxes, and got my EA license. And so EA, CPA, and a tax attorney, they're the 3 that can represent you in front of the IRS. And so that's what I am, and that's what Ronnie is. And so I've been an EA now, I think, for 5 years. And that's my other side job besides acting.
Awesome.
Yeah.
Thank you.
That's what I do.
And how about you, Ronnie?
I started doing taxes about a little over a decade ago. It's been
Right?
time flies. I also am an actor, and I'm an almost former actor at this point, I guess, because I have 2 kids and am mostly an accountant these days. But I started doing this as a side gig, and I did it because I was good in math initially. It wasn't because I had that much interest in taxes. And my wife was like, you should go over to I work at a place called Chuck Sloan, and she was like, just go talk to Chuck, because he did our taxes. And so I did, and I thought, and when I interviewed with him, he said, why do you want to do this? And I said, well, I just need a little extra money. And later he made fun of me for that, because that's not what you should just tell your hopefully new employer.
Right.
You should probably tell them you're really passionate about something. But once I started doing it, I've realized that it was a great thing for me, because I do love to solve puzzles, and I love working with other actors, because and that's what I get to do all day, at least during tax season, is sit down with other actors, and we figure out the puzzle that is their return. And so I love what I do, and like Emily, I became an EA. To be able to get more into the corporate world was more my motivation, and so that I could feel like I knew I had my feet under me for doing corporate taxes and that sort of thing.
Awesome. Thank you. And so, guys, one of the things that I really just want to bring into the room, right, is the fact that this can be an area, taxes, right, and particularly the tax reform laws, that feel stressful, right? And I think particularly as members of this industry or parents of members of the industry, it's understandable that we have a lot of anxiety around what the changes mean. And so the reason particularly why Emily and Ronnie were the guests that we chose tonight is because Emily and Ronnie are both actors, right? And I myself am also an actor. So all of us have been working in this industry for a lot of years. And so the changes impact us too, okay? Like, we are dealing with the same issues. And I just say that so that you understand that we truly know, right, how it feels, some of these changes. And let's all just sort of work together to try and be as prepared as we can be, all right? So the first thing that I want us to understand are the different types of income that exist, because everybody in this room may be earning one or more of a couple different ways, right? So Emily, can you just kind of take us through, right? We have both employee income and we have non-employee income. And let me say something about the slides, right? Because some of you in the back are like, I can't see the slides. And as we keep going, some of them are going to become even harder to read. When you click on the link to be able to watch this video, there will be a link for you to be able to see a copy of the slides, okay? So don't worry about it. We're going to explain everything that's up there, and you can take notes if you're taking notes, but then there'll be a copy that you'll be able to access, okay? So we've got two types of income, right? I can earn as an employee or a non-employee. Can you kind of just break that down for us?
Yes. And can I talk about exemptions or not?
Not yet. Yeah.
Not yet. Okay. So employee income, that is when you go to mostly a union job, right? On a lot, studio lot or whatnot, and you fill out that W-4, right? Text somebody and be like, what do I put down? Right? That's going to be a W-4, and that's going to be a union job. That means taxes will be taken out. Social Security and Medicare, and we'll talk about the rest later. W-9 is mostly non-union jobs or print, is a lot of times 1099 income. I can tell you're giggling over there. 1099. So that's not going to be any taxes withheld. That can also be cash. So like Lyft, Uber Eats, any of that is going to be non-taxed income, and that's all going to go on a Schedule C. Is that too far?
Yep.
Too far.
That's good. See,
Too far.
I'm here to keep the professionals in line, just in case you wondered, right?
Just an eye. I saw it.
Yep,
I saw the eye.
Yep, you saw it. Okay.
Yep.
So
Okay.
just to be super clear, and I have a little trick I do to remember it. If I fill out a W-4, I'm gonna get a W-2, right? So I sort of think divide the 4 by 2. I'm going to get a W-2. So if they ask me to fill out a W-4, I'm going to get a W-2, which means I'm being paid as an employee. Taxes are going to be taken out. If I fill out a W-9, I'm going to get a 1099, right?
Yes.
Which means no taxes are taken out.
Yes.
That still means I owe taxes, but they're not actually taking them, right?
Right.
Okay.
Right.
So just to get a sense, how many people in the audience, raise your hand if you are primarily paid on a W-2, primarily? Okay, so that's most of the audience. And I understand, guys, that people are watching and that, I can't ask you questions, but how many people feel they are primarily paid on a 1099? Okay, so much fewer. And just so we know, because we're going to go through all of this, how many people in here are already corporations? Okay, so not halfway. Okay, so not very many. Okay, so first of all, you guys see we've got quite a mix that we have to address, right? So everything isn't necessarily going to apply to you, but we're going to try to be super clear about what we are talking about. Okay? Yeah. Fair.
Should we address the corpse or no?
Not yet. Oh, yeah, because some people raised their hands to show us that they had corporations.
Now, corpse, you guys get 1099s or nothing, right? But you guys know that. Ooh, that was fun. But you guys get 1099s, Ronnie, right? They get 1099s or
If you
nothing.
get anything, you might get
Yeah,
nothing,
you might
yeah.
not get anything. But you guys know that because you are already in the game, right?
Okay, so we're going to get even clearer. We're going to dive deeper into that. All right, so nobody panic. Take deep breaths. I just put up a tax form. Okay, all right. Now, the reason why I put this up, all right, this is the 2017 tax form, right? But what I want us to get clear on, and this is what I'm going to have our experts help us with, is I want us to get clear on what we used to be able to do, so that then, right, we're going to get clear on what we can no longer do. It's like when I sit down with my 10-year-old and I say, this is what you used to be allowed to do, and now mommy's changed the rules. And this is what we're now allowed to do, right? Okay, so this is what we're gonna do. So Ronnie, on the form, on the 1040 form, there was a place where I put my W-2 income,
Right.
right?
Yes.
Okay. And also on the same form goes if I have 1099 income.
Sort of.
Sort of.
Yeah.
Okay.
So the way to think of it, the way to think of a 1040 is like it's sort of the central it's the form, it's the central like form that every other form is going to feed into. So when you're doing it on software, it's kind of easy because you just click through and it takes you to the other forms and stuff. But everything feeds into these 2 pages. And I've heard tell there might be 3 pages with the new
Oh my God, have you seen
2018.
the new one?
Have you seen it yet? I haven't seen it.
Can I just say something? The reason that we're using this, I told Miata, because the 2018, y'all, it is this big. It is.
Oh, is it super
I'm not
short,
kidding.
small? Oh, I didn't know
And
that.
I looked on the IRS website. It's still in
Interesting.
draft form. Still in draft form, huh? Nothing is finalized yet, and it's more confusing than this. I'm not kidding. It's gonna be fun.
How can it be that small?
I don't know.
That's strange.
Schedule
Okay.
C is Form 1. Well, I don't.
Okay,
know.
no, stop
Okay.
with the
Sorry, I'm sorry.
stop with the schedules
all right.
and the initials and
Well-
stuff. Okay.
I'm getting in trouble.
So, I mean, I haven't seen the new form yet,
awful.
but it is awful apparently.
Okay,
But
so
what's
W2.
but W2 income feeds into what you see there is line 7.
Mm-hmm.
1099 sort of feeds in there, but I kind of have to talk about it.
Yeah.
It used to be a Schedule C because
Yep.
it only feeds in the net profit from your Schedule C. So
Okay.
your 1099 feeds to the Schedule C, and then you.
And we're
net
going to put
profit.
a Schedule C up too. But basically, what Ronnie is telling you, and you tell me if I ever say anything that's wrong, basically, what Ronnie's telling you is that for the 1099 income, on the 1040, it would be the net, right? Which is all of what I earn is the gross, right? Everybody gets that. All of what I earn is the gross. And then for the 1099 income, I get to take off on the Schedule
C.
C, I get to take off my expenses, and then what rolls in here is the net.
there, yeah.
Got it? Right? Okay,
That's it,
awesome. So also on this form is where we used to put our employee-related deductions.
No.
No.
You not necessarily. I mean, those go on the Schedule A, and they feed into the itemized deductions.
And they
So-
feed in here
So that's
Okay.
So again, it feeds in from another schedule.
from another
so
schedule.
they end
Right.
up there, but they
Yeah. So they end up here, right? So, and again, guys, this is the reason why we're breaking this down so carefully is so that we understand that the 1099 income, right? I have deductions that are related to that business. The W-2 income, those were different. The deductions tied to that would roll into a different part of this form. Okay? Got it. Okay, great. And then, is there anything else important on this form? Oh, yes. Okay. We used to get exemptions, right?
Right, correct.
So can you explain what those were?
An exemption was just a deduction for being alive.
For being alive.
So you got the either you itemized or you did a standard deduction, and then on top of that, so if you look at the top of the page 2 is where your adjusted gross income comes in, and then you start deducting on the next 2 lines or next 3 lines, and so you'd either take the itemized deductions or the standard deduction, and then you would take an exemption for every person in your household. So the exemption is usually around $4,000. I think it was 41 last year. So if you had 10 people in your household, then that was a 40 grand deduction. And that they've now done away with.
What we're gonna get to that later. We're just talking about what we were allowed to do. Right.
We were allowed to do that.
So we used to get a deduction just for being alive, right? And each of your children also got one.
Exactly.
And that would go here. Okay, great.
Right, yeah.
And then the last piece that I want to note that was important here is the self-employment tax, right? So, Emily, where does that self-employment tax
come from?
Yeah.
Yeah.
What's that based on?
So you know how we talked about the net of the Schedule C, right? Gross minus expenses, we get the net, and that's on line 12. Yep, you're following. I know you got it. You got it in there. So that net is what the self-employment tax is based on, and I'm sure you've heard, oh, you'll get double taxed on that. it's not really double taxed. What it is self-employment tax, which is the Social Security and Medicare that wasn't taken out because it wasn't on a W-2. Okay? So you got income tax and then self-employment tax, which is based on that net income of line 12, and that's on line 57.
Okay, so that's a big thing to understand, is that the 1099 income, and this is one of those areas where we definitely see people have problems, right? Because you get all the money, but all the money isn't yours, right? And so when you get the money, you need to be really aware of this self-employment tax, and you need to really understand what percentage of that money you should automatically I set up a separate bank account, and every check I just siphon off that percentage and I send it to the separate bank account like it was never mine, right? Because with the W-2, they do that for us, but for the 1099, they don't, right? Okay. So this is an important form. This was the Schedule A, right? Because, guys, this is where all of our itemized deductions came from, right? And so I just want to run through the categories quickly. We used to get deductions for medical and dental expenses, right? Also, for the taxes that you've paid. What kind of taxes that I've paid did I get a deduction for?
Your state and local taxes, your real estate taxes, personal property taxes.
So my state
DMV.
and local taxes, my property taxes.
And your like DMV.
And your
there
all
might be
those
foreign
things.
taxes there if you have some foreign taxes.
Okay, so all of those things I used to get a deduction for, right? Interest that I've paid. Like, what would that sort of be like? Like on my mortgage?
Yep.
Okay.
Mortgage interest and all that fun stuff.
And if I had a home equity line of credit, I would also get a deduction. I used to for the interest on that. Okay.
Yes.
Okay. Awesome. And gifts to charity.
Yep.
Right. I get a deduction on that. Casualty and theft losses. I never knew this.
That's a tricky one.
It is a tricky one.
You probably don't want to get too deep into it, but
Let's not.
it's a tricky one.
Okay. Okay. So hopefully you don't have any casualty or theft losses. Okay. But then
If you do, ask your tax professional.
ask your tax preparer,
They'll
right?
help you.
But then we had a big one, which were job expenses and certain miscellaneous deductions, right?
True.
And all of these things, along with other miscellaneous deductions, would total our total itemized deductions. Everybody clear on that?
But
Okay.
this is just W-2.
Just W-2.
Just W-2.
Okay.
Not 1099.
So this, and especially the job expenses, that's the key, right? Is that it's job expenses, which the W-2 is like a job, right? You have an employer, versus the 1099, which is more like a business. You're an independent contractor. Fair? Okay. All right. So just quickly, and then we're going to get to the changes, right? But just quickly, so that we see the difference, this is the Schedule C that Ronnie was talking about. And so, Ronnie, with this is where I would take all my 1099 income.
Correct.
And then
Plus what? Be 1099 income plus declared cash income, because
All income.
you are supposed to put any income there that has been reported or not reported. It's supposed to go there. I leave it up to you to be honest or not. And
All income.
All income. This is on tape. All income. You must report all income. And then you'll see so part one is all the income like items, and then part two you have the expenses. So you literally it's like if it's however many expenses you take that off of the income, with a few minor exceptions where your meals are cut in half and things like that. But then the number that shows up on line 31 is what transports over to line 7, I think, of the 1040.
Line
Okay.
12.
Line 12. That's right. 7 is W2.
Okay, So now what we're going to look at, guys, is uh-oh. There we go. He said a deep breath. Okay. So, key 2018 tax law changes for those who have been itemizing deductions. Okay. Just to get a show of hands, a lot of hands went up for W-2 earners. How many of you are clear that in the past you have itemized your deductions? Okay. So this is most of the room, okay? So this part is now talking to most of the room. Not everybody, but most of the room, all right? So let's look at what the changes are. So you remember I went through the list of all of the things that we used to take and itemize. Now we're going to go through that same list and look at what has changed. So with medical and dental expenses, Emily, what's different now as opposed to what I used to be able to do?
So it's, yeah, I believe it's lowered to 7.5%, but I believe that's how it was in 2017.
It got changed back to 7.5, so that's not a change.
Yeah,
Oh.
no change for 18.
Okay, so
Yeah.
just so everybody understands
Oh, they probably don't understand.
what this means,
Yeah.
right? Is, and let me see if I can understand. If I make a certain amount of money, if my medical and dental expenses total 7.5% or more of how much money I make, I'm going to be able to take that as a deduction.
No.
No.
Right.
So say, I know.
I know.
So say like your AGI. So say like you hit more than the 7.5% of your AGI. You probably still don't get
AGI
it.
is
Adjusted gross income.
okay.
What is that? I know. So it is going to be, I believe it's line 39 and it flows to line
Don't worry.
37.
Don't worry. We don't need to know that.
Ronnie.
Very bottom of
It's the very bottom.
and the very top. Bottom of page 1 and top of page 2.
Yeah. So when you go to your tax preparer, I always run through mine with my clients. I run through it and I say, this is your AGI. Because when someone says, hey, what's your AGI? You'd be like, hey, I know it, right? Because you know it. You should know your AGI.
But your adjusted gross income
income
is what I earned minus some stuff?
Yeah, it's minus some adjustments. And adjustments, you may not have adjustments. Adjustments are like self-employed health insurance, student loan interest, self-employment tax. You get to take half of it as an adjustment. These are a few things that will help you get to an adjusted gross income. Your AGI might be your total income. But any hoosers, you got your AGI, okay? So say your medical expenses are a bit over 7.5 of your AGI. You can only take what's over 7.5 of your AGI. Just because you hit it doesn't mean you get to take it. It has to be over, and the amount that's over is what you get to take. Okay? I know.
I like my way better. Okay.
I like your way too.
No, so we're not going to take questions yet, okay?
No, it's not. It's not. It's adjusted gross income. Taxable income is later on.
Okay. So that's medical. Now, taxes paid. This was a pretty big change, right, Ronnie?
Yeah, it's a big change, yeah.
Okay.
It's especially a big change for homeowners.
For homeowners.
That's the biggest change because a homeowner is going to have substantial real estate tax on top of their state taxes paid in. So to have that, especially out here in California, to have that limited to $10,000 is a pretty big deal.
Okay. So does everybody understand what happened this year from 2018 forward, you will be capped to $10,000 on that area. So here in California, it is easy for your property taxes alone to be $8,000-9,000, right? Annually. And so then, regardless of how much my state taxes were,
Right.
the max I'm going to be able to take is $10,000
And we live in the highest tax state.
in the highest tax state.
So it's
okay.
a sort of double whammy. for
Okay. So
California.
it's a double whammy. Okay. Bummer. All right. So interest paid. because this also changed. So I understand I used to be able to deduct all of the interest that I pay on my mortgage and all of the interest that I paid on my second mortgage. But is that no longer the case?
Well, you can still up to a $750,000 limit. You can still get the deduction
Okay, so if I owe more than $750,000 on my house,
on your loan. Then I don't know how it's going to be calculated yet, but I'm assuming we'll just be taking a percentage. So if you have $1 million loan, then I'm assuming we take 3/4 of your mortgage interest.
okay.
There may be some calculator that the programs use. I don't know. That's what I would assume.
Okay.
And then for your home equity line of credit, as long as you use that home equity line of credit to improve the home, then you can continue to take that as a deduction. But if you use that home equity line of credit to, say, pay off student loans or to do something else with it, then you can no longer take that as a mortgage interest deduction.
Okay.
That used to be a nice little loophole in the past, because you could, instead of borrowing money outside of your, not off of your home, you could borrow money off of your home, pay for your boat, and then write off the interest payments on it.
Got it. And
kinda
so
nice.
now, unless you can document, right, that
Right,
home
yeah.
equity line of credit was spent improving the home, you cannot take that interest. Okay. Gifts to charity, I'm still able to take those. Okay. So
They
that
raised it to 60% of your income.
of
though.
your income. So
Used
you
to only
can
be 50%.
you
Now
can give
more.
away 60% of what you earn and still get a tax deduction. Okay, great. Okay,
Let's have a show of hands. Who gives more than 60%?
their income away.
Nobody?
Okay, so can you hold questions until the end for me? Okay, so job expenses and certain miscellaneous deductions. Guys, this is the biggest change, right? So the old rule was that we were allowed to claim as an itemized deduction the amount of money that we paid for job related expenses, right? And so I just want to be totally clear. That is now gone?
Gone.
It's
Okay.
not there anymore.
Okay. So let's say that again, because this is obviously, right, the place where this law at this point in time is not taking into account this particular industry. Because do we all understand that your typical, for lack of a better word, W-2 earner, they are not spending money for their job. You understand, right? Most W-2 earners, they have a job, and if they spend any money on that job, they get reimbursed, right? But for people in this industry, actors, writers, really anybody in the entertainment industry, we spend a good amount of money to work. And so there's no allowance for that.
There's no allowance for that anymore. And it's always been a bit of an awkward thing, because really as an actor you're running a small business, but because the Screen Actors Guild and the unions have gotten us paid as employees, which is a better way to get paid to get paid. The downside is that now when you is that we've already been at a little bit of a disadvantage putting it here on the Schedule A.
Right.
And now they've taken it away completely, and I believe it's because it's a very abused part of the law. But they're obviously, like you say, they're not taking into account actors and people who have to have representation, because you're paying your 10 or 20% or 25% out of your W-2 earnings, and because you're the one earning it, not your agent. So then they can't really pay your agent off directly.
Right. And so if I earn $10,000 on a job, right?
Right.
And I have to pay 10% to my agent,
Right.
that would be $1,000. And let's say I also have a manager and I have to pay 15% to my agent. That would be another $1,500.
Right.
So now I am seeing $7,500 of that $10,000.
Right.
But I'm going to pay tax on the
10,000.
full $10,000.
Correct.
And my agent and manager will also pay tax
On their
on
2,500.
their 25%. Okay. Okay. So one of the biggest reasons, right, that we're doing this is because you guys understand none of us up here wrote the law, right? You understand that, right? And this is honestly the place where I've done a few of these now over the last couple of months. And this is honestly the place where I just need to share with you that we up here start to feel anger and resentment wafting up towards us, okay? And so I really need you to understand that, like, we didn't do it, okay? We didn't do it. And what we're trying to do is just see how we prepare for what the truth is right now. And I'm just going to ask you to hold it, your questions. Okay, guys, let us get through this, and then we will take as many as we're able to do. Okay, so first of all, right, let's address the fact that the standard deduction has gone up, right?
Correct.
Okay, so if you look at this chart, the first thing to know before we all totally freak out is that married filing joint, you used to, I know none of us took it, we were itemizing by most of the hands that went up, but that was maybe because your itemizations were more than 13,000.
12. It was 12.
For married filing joint, oh, sorry,
Yeah.
this is wrong. It was
That's okay.
12, and now it's 24,000, okay? Married filing separate? Married, is this right? Married filing separate, I used to only, my standard would be 6,500. Now it's 12. Single person, 6,500. Now it's 12. Head of household, 9,550. Now it's 18,000. Does one of you feel comfortable explaining, because I'm not clear on this, what is head of household?
So head of household is when you, it's a little hard, but head of household, there are several, stipulations to it, right? We have to do so many
Yeah.
checks
It's always a
in
pain.
the software to get head of household.
Essentially, it just means you're
You're a single parent,
You're a single parent.
basically.
You have a dependent.
You have a dependent.
It could be your parent. Your parent could be your dependent.
Yes.
Also,
It means you
if
have
they
a
live
dependent.
with you, I think they have to live with you.
They have
one
to
of
live
those-
with you. Oh, Lord. There's so
We
many.
always say it's one of the most basic things, but I'm having to look this up all the time. Head of
Every time
household.
someone claims head of household, I have to ask them so many questions.
Got it.
But it's very tricky, especially if you've divorced or you separated from your husband, you didn't live together the last 6 months of the year. You can also claim head of household. So it's definitely one of those tricky ones. But if you can claim head of household, you will know because you are a single parent or you have a dependent in your household, and you're like, I know I can claim this, and you talk to your tax preparer about it.
Okay, so that's the first thing, is the standard deduction has gone up. Now remember the exemptions that we talked about that we used to get just for being alive, we don't get those anymore, right?
Correct.
Now, do I get anything for my children in terms?
Well,
You get-
get a double child tax
Yeah.
credit now. So that's where they try to make up for it, is without the exemption, but now you get the child tax credit is historically been $1,000 and now it's $2,000.
Okay,
So go have some kids
okay. So, okay.
because they're really cheap and you get that $2,000 back. Really great.
Yeah.
It's worth it.
So, I am not trying to rub salt into any wounds. I'm truly not. But I want to talk through something, because I want us all in the audience to really get clear on where we are, right? So each of you really understanding where you are so that you understand how this might impact you, okay? So I just am going to run some really loose numbers, okay? And I didn't give this to them beforehand, but this is super, super loose, guys, okay? So they're scared now. Okay, so let's say that I am an actor or a writer or, you know, an entertainment professional, and I earned $60,000 in W-2 earnings, okay? Now, I was just doing some math. Let's say I had an agent, so 10% would go to the agent. That would be $6,000. $9,000 would go to my manager if I had a manager, right? I would have gotten a $4,000 personal exemption. So I'm sort of looking at if this were me in 2017, right? Just for being alive, I would have also gotten a $4,000 personal exemption. Now, let's just say that in addition to my agent and manager and my $4,000 personal exemption, let's say that I had $10,000 in additional legal deductible expenses, right? So, am I right? That calculation would have been that I would have been $31,000 in taxable income, but you know, with some other stuff. This is loose, right? So if I look at the tax brackets for 2017, right? 31,000 in taxable income would have put me in the 15% tax bracket, right? So loosely, if we do the math and we did 15% of 31,000, that would come out to be 4,650. Right? You guys understand this is just really loose numbers.
It's not exactly how it works, but
It's
we'll
not?
come back around to it.
Okay. Am I even
wanna
close?
finish?
We're
No,
doing.
well-
We're loose, Ronnie. We're loose.
We're loose. Yeah. All right.
Okay,
Sorry.
'cause then I want you to help me. All right. So So that would be $4,650 that I would owe in taxes. Okay. But then in 2018, same thing happens, right? But I lost my agent deduction, my manager deduction, my personal exemption deduction, my $10,000 in additional deductible expenses. I have to take the $12,000 standard deduction, right? So now I've got $48,000 in taxable income. That puts me at the 22% tax rate for 2018, which means that, I know this is loose, $10,560 would be my tax burden.
Well, no, because
No.
and I do have to correct you there.
Please
because
do.
You don't, when you hit a bracket, it doesn't mean that everything.
Yeah.
When you go $1 over a bracket, you know, I've heard it all my life where people said I got a raise and now I pay more in taxes. So I really didn't. That's impossible because you only pay what is over. Once you hit the bracket, it's only what's over that.
Okay,
that
that's
point.
good.
Yeah. So like they've lowered the tax rates, as you can see. They went from 15 to 12, 25 to 22.
Right.
So in general, what I'm seeing is people are getting a tax break under the new law. In a situation like what you're saying, they're not going to, because you have so much more taxable income in that scenario. Which is what we'll talk about later. About
Okay.
corporations.
So so the good news, right, is that's one of the places where my math is way too aggressive.
Right,
Basically.
because you would only pay 10% on the first 9,500, then you would pay 12% on the next. What is that, about 30,000?
Right.
And then you would start paying 20%.
Okay, so that's really good to know. Okay, but the loss of those deductions could really mean an increase potentially,
Significant there.
a significant increase for some people. Okay.
That
Can I
scenario
just
is
say
significant.
something? Because I can feel you. I know. Can I just say something? We're already in October, right? You guys, there's not much we can do. So let's just all take a breath. Well, thank you. Yes. Okay.
We
All
can vote,
right.
is what the audience is saying.
Not
Yeah.
the time to yell at us. Thank you. What I'm saying is, please don't run out and incorporate, because that is not the answer either.
Okay, we're going to talk about that. We're gonna
I know,
okay.
but give me a second.
Yeah.
You got to say what you wanted to on that, so give me a second. It doesn't mean that you are going to owe a lot. I don't know. I'm assuming your software generated a 2018 peak, because mine did. Yeah. So when you went to your tax preparer, they might have been able to give you a peek at what 2018 looked like with 2017 numbers. So if that happened, take a look at it. It doesn't mean that you are going to be so, you're going to lose $5,000 to $10,000 next year. Even people with one W-2 are looking at a different scenario next year, okay? So don't think that we're the only losers out there, in 2018. It is going to be a shit show, and excuse my language, but it's going to be a hard one for everyone, not even hard, but it's going to be new changes for everyone, okay? So we all just gotta, work through it. We're gonna be okay. I have not incorporated. I know we're talking about it later, but I have not either. So we're just gonna have to take a deep breath. It is October. We only have 2.5 months. There's not much we can do. All right.
And
so
what I do feel we can do, right, is that if we now can leave here, and if you find out that, I am likely to owe more than I expected, or to owe something, right? Where I believe that we can be prepared, not panicked, is that you have a few months to sort of start trying to put away a little bit more towards that, right? So that the emotion and the upset about it doesn't change the fact that that's, if that's the truth for you. But you do have some time, and that's the really good news, okay? So let me ask you guys, and I'm gonna start with Ronnie with this particular question, because Ronnie does a little bit more on the corporate returns, although Emily does them as well, right? But at what point should I be thinking about incorporating? What makes sense?
Well, it's going to be a personal question for every person.
Okay.
It's going to be case by case. It's a case by case sort of thing. What you have to look at is several things. Probably the way you can tell the best is how much are you saving by being incorporated, and does that overcome the costs of incorporation? Because incorporation is not just about your initial cost and startup cost. That is what it is. It's not even that bad. But then after that, when you have a corporation, then you're carrying yearly costs with that corporation. Because you, not the least of which is you have the $800 California franchise fee, which the folks who are incorporated know about that. That is whether you make any money or not on your corporation, you're going to write a check to California for at least $800. You have to do a corporate tax return. Your corporation is not you. It's a separate entity, so it has to have its own tax return. That's typically going to be double what your personal tax return is. You're going to have to, and you still have to do a personal tax return. You are going to have to pay yourself on payroll when you're a corporation. So you have to, because by law, when you are an S corporation, which is what we're talking about, the IRS requires you to give yourself a reasonable wage. And so that means that costs money to have payroll run. And these are all things that I do, but I won't say what my costs are on everything, because I'm not advertising for me, but just a sort of say, because then on top of that, you also would probably want to have someone help you with your bookkeeping and your accounting, because you're not just talking about income and expense anymore. Because when you enter payroll into the thing, and you're also dealing with things like shareholder distributions, so now you have things besides income and expense account. You have accounts. You have a proper chart of accounts that an accountant would set you up with liabilities and equities and assets, and how the bank account's going to feed into all of those accounts, so that you can actually run a balance sheet, not just a profit and loss. So you add all those costs up, and I typically tell people expect to pay like $3,000 a year. So then you'd want to weigh that against, And $3,000's probably, it depends. It could be a little more, a little less. It depends on how much of you want to try to do yourself. And trust me, you can get yourself in some big trouble because you open yourself up to some major error by doing it yourself. But it is possible. And so you got to figure, if you take that, if you say $3,000, then how much am I saving? And the way you can tell how much you're saving is to say, what is my tax bracket, by looking at these tax brackets. And remember, when you're looking at these tax brackets, to take into account that you're going to take $12,000 off the top of these. So when you see $38,000 as the 22% bracket, that really means that you've made 50, because you're getting a $12,000 deduction off the top of that. So what bracket are you in? And you can add that up between federal and the state, and then how much have you spent? So if you're in a 22% bracket, and you're solidly enough into it, you're not just at 38, you're not just barely in it, but you're in it, and that means your California taxes are probably going to be at least 8%, maybe even 9% at that point. So you figure 30%. So to break even, you'd have to have $10,000 in expenses. Under the thing that you just gave, you'd be, if you have 25, was it 25 you had in expenses?
Well, with the agent and managers and yeah.
Yeah. So if you had $25,000 in expenses, then you're going to come out ahead being incorporated. The other thing, though, that you want to think about is, just because you have, as we know, this business is very fickle. So if you have a great year in commercial, commercials specifically are where you can really go up and down. I mean, it happens in every part. But you can have a great year one year commercially, and then the next year have, hardly anything. So then you're stuck with that $3,000 in expenses.
Right.
Now, the other thing to remember is that you're never going to lose that whole $3,000, because you are going to get some benefit out of it. So if you're feeling consistent with things and you're making, like, say, in the $70,000 range consistently, and you have $20,000 in expenses, you probably should incorporate, because you're benefiting enough. And even if you have a down year, you'll probably benefit enough you may not break even, but you're not going to lose a ton of money. And then you're set, especially if you're someone who's hot at pilot season and is in that game, like really getting those kind of opportunities, then you really do, at that point you probably do want to be incorporated, because you want to be ready for something big to hit.
So thank you for that. And the thing, though, that I always feel I want to stress of what you just said is the consistency, right?
Right.
So one good year, even 2 good years, and I probably really still need to be very careful about making that decision, right?
It depends on how good those years are. Because you could lose a lot of money if you have, like, an incredibly good year. So it would be worth being incorporated if you had because before I would have said you don't want to even think about incorporation until probably $150,000, and now it's
150 is what he said he used to say.
Yeah,
okay.
And now it's about half that. If you're consistently at that level at like 70, and you have an agent and manager, so you're paying out 20%, then you're more than breaking even at that point.
Okay.
That's just with your agent and manager fees.
Okay.
So if you're consistently there, then it's not a bad idea to incorporate.
So consistently, right?
Right.
And that's the place that everybody's going to have to judge. Now, let's say, right, that I've been consistently there. I form my corporation. It goes fine for a couple years, and then it's like there's nothing. So maybe the first year that's okay, and then maybe there's another year where it's nothing. Is there something I can do? Can I change my mind?
Yeah, you can. You're not stuck with it forever. You can dissolve the corporation.
Okay.
So
that's not super hard or expensive.
It's not super hard. The only part that's probably difficult is if you have a lot of theatrical residuals still coming through, then you have to call those people and make sure you got to call all of those people and make sure that they change that over to your personal thing. And it won't come on a W-2 anymore. It'll come like as a 1099 for income. Yeah.
Now, what about, am I losing any of the safety net that I have as a W-2? Am I losing unemployment? Am I losing Social Security? Am I like no.
Because you have to because you have to give yourself a proper payroll. You're also paying into unemployment. You're paying into Social Security, Medicare. You're paying into state disability. So all of those things are still there. It's just that now your corporation is the actual employer, because you are oddly like the corporation is this thing over here, and you own it, and you also work for it. So it's a strange setup, but it's been it's been something that's been around. Specifically, the S corp specifically has been around for the purposes of small businesses. That's the reason it exists.
Okay. And I really, really want to stress, guys, that I don't believe, and please disagree with me, but this is not something that you just go out and do yourself and you go online and you do it. Because one of the things that I feel I see a lot are people who formed corporations and they're not running payroll. They're not
Exactly.
Right? So
and that puts you at great risk.
At great risk. Everybody hear that, right? It really puts you at great risk. So this is something that if you're even thinking about it, you need to make sure that you have the specific counsel of someone who knows your situation and helps you walk through doing this correctly.
Yeah.
Right? Okay. So I want to ask you a couple of questions about parents of young performers, because I think we have some people in the audience who are parents of young performers. But before I do that, I did not bring up my phone. I don't have a watch. 7:33. Okay, so we're coming down the wire here, and I want to try and get to some of these questions. So parents of young performers, right? Guys, at what level of earnings does my child need to file their own tax return?
Well, I have the numbers right here.
Okay.
Well done.
But I have to say, I looked on the IRS website, and it was only 2017 numbers. So 2018 numbers are still not on the IRS website yet that I saw today. But if the dependent child, so this means if the child is still on the parent's return as a dependent, the child has to earn $6,350. So that's the standard deduction in 2017. So that's earned income or unearned income of $1,350 or $1,035. And unearned income, that is dividends, interest, that would be investment income.
Okay.
Does that make sense?
Yeah, so then they have to file their own return. So the parent, would be filing a return, the child would be filing a return.
Yeah.
Right? Now, what if basically my child and I are essentially in business together, where my child is the performer, I am, let's say, their manager, right? And my job is managing my child's career, then are they paying me how do I still file my own return and they file their return? Does anything change? Do you know?
I don't.
If they pay you, if they're paying you as a, it depends on the deal you have with your kid. So if you're, yeah, because if your kid is paying you a 10% or 15% manager fee, then that's income to you, and it's also off of their books. So they write it off of theirs, and you bring it over to yours, and that would be. Then depending on how you do, I mean, typically that would be 1099 income.
Okay.
That you'd be taking, although they could set you up as an employee.
Okay.
If they had a corporation.
If they had a corporation, they could set me up as an employee. But now, last thing, because I feel like this could happen. So my child is building a career, and we have all of the expenses, right, related to that career. And I know if they're earning on a W-2, it just doesn't matter because those expenses can't be taken anymore. But if they are like being paid largely 1099, the expenses related to my child's business, even though like I may be the one who's like paying them, those expenses go on my child's return, not on my return.
Not if you're paying them.
not if I'm paying
So
them.
you want them to reimburse you.
Oh, okay. That's important.
Because if you're paying them, then that's a gift to your child.
Oh,
That's all it
okay.
is. It's just a gift.
It's just a
Yeah.
gift.
So you gotta have your child reimburse you for those.
Okay, so that those deductions can
Sounds-
be taken
sounds
against
brutal.
their income,
Take
right?
their money, make them pay for it.
Okay, make them pay for
Yeah.
it. Okay, great. So,
Can I
yeah,
say something real quick
yes.
too? I think for anybody who does like shepherd their child's career, I think it's really important to have at some point show them the taxes, show them how taxes work, show them their expenses, like sit down with them, because I just think it's really important to let them know how much money is going out, because they're probably if they're old enough. If they're young, they probably don't know anything. But if they're old enough, they might start realizing how much money's coming in, and they're like, "Well, where's all my money going? I made $1 million, and I only have $400,000 in the bank or whatever." And so I think it's very important to make sure everything's transparent. Let them know how the money is flowing, how much money is being paid in taxes, and the whole nine.
Yeah, and I'll echo that, just because I really believe that as a culture, as a nation, right? Many of us, we just didn't grow up with a financial education, and then we go out into the world, and our parents tell us to just sort of be responsible, right? Do the right thing. But you don't really understand what that means. So I feel like it's actually a gift, where we as parents might be inclined to think of it as a burden. It's a gift, right? If we can involve them from the get-go or as early as possible. So I'm skipping all of that. Okay, I want to just ask you, the state, has California conformed to the federal law? Because don't all of my deductions still count for California?
Yes.
Ooh, right? There's some good news.
As far as we know.
As far as we know.
Right, Ronnie? As far as
Haven't
we know.
heard yet.
So we might.
Haven't heard them say
the
not.
thing. We still don't. Sorry, I keep touching you. I'm a very touchy-feely person. As far as we know, because we still don't have the big tax book, because we do our continuing education credits from now until December. I believe what will happen is we will have to do a federal return and then a separate state return if you have business expenses. W-2 business expenses. So you will still be able to take them, just only on the state side. So I'm telling all my clients, keep your expenses, keep tracking them, because we will be able to take them on the state side, as we know right now.
Awesome.
Yeah.
Awesome.
Yeah.
So that's really huge, right, guys? Don't throw out the baby with the bathwater, right?
Yeah.
Keep doing and tracking your deductions, because you can still, as far as we know, take those deductions on the state side, right? And so let me ask you guys, tied to that, how do we know? Where can I go look to know what does or does not qualify as a legitimate business expense? Because even though they're gone on the federal side, if I can still take them on the state side, and how do I know? Because I used to hear that, like, if I got my hair done, I was allowed to deduct that as an actor. But I understand that, no, I can't. And I can't deduct, the gym membership. But so there are a lot of myths out there. How do we find out this is what we are allowed?
Just take a few days and read the tax law. No, I'm kidding. Don't do that. It's not worth it. I think ultimately you ask your tax professional, because it does come down to specific stuff. So like hair is not a deductible thing, but it can be if it's specific to a job,
Particular job.
and if it's required by the job and they're not paying for it for you. And to some degree, there's probably some leeway in there. If for instance, if you get it done for a headshot session or something like that. Mm-hmm. But in general, if it's something that you carry into typical life, like into regular life, that's where they kind of. So in other words, with clothing, and a lot of times people think you can take your audition clothing. And I guess technically maybe you could, if you like hung it up in a separate closet and like you only used it for auditions, then maybe you could make that case. Because if you were audited, they would say if it's regular streetwear, you can't you can't take it.
Okay.
And so it's the same idea with hair, because that hair is going to stay the way it is, you
Right.
know. Now, if you got it colored
For a specific
for a
job.
specific job, then
Okay.
then that makes it a business expense.
Okay, so one of the things that I suggest is like, I know our tax preparer, and you can even find these online, but like you guys, presumably you have packets that
Right,
you
yeah.
give your clients, right? And those packets can be great guides. So I usually recommend, get a packet that shows you what your tax preparer will need to know, right? Because then
Right.
that'll help you know what's allowed and what you should be tracking, right?
Right.
And tied to that, what records do I have to keep to prove those things? So how do I make sure I'm prepared, right? I claim it, it's a legal deduction, but then I get audited. What do I have to show?
Well, I mean, receipts, but
Right.
anything under $75, they don't need a receipt, they say. Did somebody say what? Oh,
What?
that was so cute. I know. Oh, honey. Okay. They don't last.
Right.
So
I know. Sorry.
Oh
I
no,
get-
no,
I
it's
get
okay.
caught
It's
up.
just the
I get
audience.
caught up.
Just so we know, I've been told, guys, when you guys speak in the audience, what's happening is that for the recording, it's completely and totally dead
Can't
air.
see. We
So
can't
we
see.
look like we're just talking
Okay.
at nothing.
Sorry.
No, that's okay. And so yes, someone in the audience is
Yeah.
going through an audit, and
It's a lot. So you want to keep all the receipts that you can, email receipts. Bank statements are iffy. I'm going to say that. It is a gray area because I have heard of people having audits, not my clients, but someone that had an audit and they didn't accept the bank receipts. That was a few years ago. That could have changed by now, but don't solely rely on your bank statements. Have receipts also. Any kind of paper trail you can have. I know it's tedious. I know you're probably rolling your eyes, but if you can have some sort of paper trail and bookkeeping to back everything up, that would be great. I also have a calendar where I write everything down. So as much as you can keep, a daily calendar of what you spend and where you spend it, that would be the best I can say.
Yeah, and the same. Essentially, if you have a log to go with it, what you're saying with the calendar, and that goes. So mileage is probably the biggest one, because mileage is like.
Can you explain how or what do we have to do to
You
track and
it.
prove mileage?
A lot of people use the Mile IQ app or other mileage apps, and you have to keep track of what is your business miles, meaning your job search miles, essentially, which can include like coming here tonight or classes or things like that. But it isn't your commute miles. So if you're working, if you're a series regular, technically those wouldn't count. Or if your side job you're going to every day, that's a commuting mile, not a business mile. And as long as you're keeping, and so you need to know how much your business miles, and you need to know how much your total miles are on your car. So that's very important to know what are your total miles for a particular year.
Okay, awesome. So I've been given the 15-minute warning, which is good. We still have 15 minutes. That's good. And a number of you filled out cards with some questions. And so I've also been told, guys, that the questions in the audience, if you didn't fill out a card, I'm not able to take the question because no one will be able to hear what your question is. So a lot of these, it's really interesting. I feel like we've already answered. But here's one where I want to clarify. So, how should you file taxes for a minor child actor? Now, we talked about this. Separate from parents or all together. But here's a question which I really want us to be. They said, should it be based on who earned the most for the year? No, right? It is not about that at all. You both have to file a separate return as long as the child earned more than whatever the standard deduction
Exactly.
is, right?
Oh, and one thing I wanted to say there, and maybe it goes without saying, I'm not sure, but if your child had any withholdings,
That's what I was going to say.
then you gotta file to get those withholdings back.
Yeah.
What does
So
that
even if-
mean?
So if you're getting beyond your Social Security and Medicare withholdings, which are automatic, but if there's a number in box 2 on your W-2, which is your federal withholdings and your state withholdings, then if you want to get that money back, so if they only made $6,000, they're under the threshold, but they took out $600.
Right.
Then you can get that $600 back, but you have to file
a return.
Get the $600 back.
Good. So let's clarify that really quickly. When we go and we fill out those W-4 forms,
Yes.
right? And they are asking, what number should I put on that form? Because that number has to do with how much tax is going to be taken out, right? And I've gone on jobs where, like, I've been sitting next to someone and they're like, oh yeah, someone told me to claim 7, right? Or someone told me, because then you get more money, right? But what should that number actually legally be?
It should be the number that's on your tax return.
So what is that? How do I?
So for a single person, it should be 0 or 1. If you are married, it should be 2 at the most. You can put 0 or 1, but it should be 2 at the most. If you have 1 child, it can be 3. It can be 3. You can put, the most but and less, but you shouldn't put more. Right. You should not put 9. You should never put exempt. Unless you are exempt, which most of us aren't. So please don't do this, because you'll come to us, and I'm sure you've had this, where there's no federal tax withheld on $30,000, and it really, it's a shocker, because then that person owes on their $30,000 of income.
I think a lot of times, I'm sure you hear this a lot, but what I hear a lot at my desk is like, well, I went to this guy and he got me a lot of money back. Yeah. And you judge your tax return by how much money you get back.
Yeah, don't do that.
And that's not the best way to look at your tax return. No. I think it's line 72, I can't remember, but there's a line that says this is your actual tax for the year. Oh. Look at that, because that's what when you come into us, that's what gets affected, is your actual tax. Then the next line down is how much you had, is your credits, and how much did you have withheld. So if you're under, if your tax is $10,000 and you've only had $6,000 withheld, then you're going to owe $4,000. But if you've had $14,000 withheld, then you're going to get back $4,000. You're still paying $10,000 in tax. So that's the important number. And so if someone comes into me, like when someone comes to me, I always show them before we start putting in deductions and then after, because it's to make me look good, but it's also to protect myself, because if they start out owing $15,000, they're going to probably end up owing $7,000 or $8,000, and then they're looking at me going, "Why do I owe $8,000?" And I'm going, "Well, we saved $7,500 here today. You can't look at me. That's your fault for not having your withholding set correctly."
So this is a good time, because a lot of people raise their hands as W-2 earners. And so I would really encourage everybody, when you get home, to pull out your check stubs, right? And take a look at your year-to-date gross, how much you've earned. So if you or your child has been paid by several payroll companies, different ones, right? You need to look at the most recent one from each of those payroll companies, right? But so I would want to look at my year-to-date gross that I've earned, and then I would want to look at my year-to-date that I've paid on the federal tax line.
Yep.
Right?
Yep.
And so then
This guy's doing pretty good. This guy's doing pretty good.
I know.
Yeah, this guy's doing really well.
This is what we're aiming for.
Yeah, right.
Yeah.
But so then, what would I do? Would I take my year-to-date tax that I've paid, federal, divide it by my year-to-date gross?
Yep.
Right? And that's going to tell me, right, guys? Then that's going to tell me what percentage I've paid in taxes, right? And then what? Do I sort of look at the chart and make sure that that's the ballpark of where I should be?
That's what I do. I actually had to do this recently. And yeah, it is tedious. I know. I had like a pile and I had to figure it out. So you would take $82,140
which is the federal tax line.
You see that?
Okay.
Divided by 276,923. And I don't have a calculator on me, but whatever that percentage is, so it would come out to be 0.2345778.
Remember, we learned in 5th grade, you go droop, droop, right? You
Right.
move it, the decimal point, 2 points.
Is it 28%?
two
I mean, it's
Look
probably
at
in
you,
that-
Ronnie.
I'm just saying it's in that,
And then,
that range, probably.
and then
Okay.
it gives you the percentage.
And then it gives you the percentage of the federal.
So that again, guys, if that seems off,
Yeah.
right? If that seems low, that wow, that comes out to be I've paid 14% tax. So
About 30%.
Oh,
it's about 30% that
Okay.
this guy's been paying, about
Okay.
30%, right? So if it feels low to you, that's really just a little, not to panic, but a little bit of an alarm, right? That enough taxes may not have been taken out. And I need to plan,
Yeah.
right, for what I might owe.
so one of the big payroll companies that you might want to definitely look at is Talent Partners or Extreme Reach. Yep. I don't know if you see this constantly, but a lot of times they don't take
Talent
out
Partner.
taxes until you
Extreme
hit
Reach is not as
8,000.
bad, actually, but Talent Partners
Well,
is
did you know
horrible.
Extreme Reach bought Talent Partners?
Right, but they have a different, their setup's different. They're actually withholding at a
Oh, they
better
are?
rate. Yeah.
They are now?
Yeah.
Team isn't taking out as much. Anyway, another time. But what you can do, so say like you do see this, right? And you see that you are getting under withheld.
Right.
And even if it is October, let's just say it's July. You can call up the payroll company. You can take action if you want. You can call up the payroll company and tell them that you want to be withheld at a higher rate federally. You can. And you can also tell them if you want a little more California state tax withheld, you can tell them that too. I had this done for Talent Partners, and I see on my Talent Partner W-2 or on my paycheck, it says federal, and then it says the percentage, and it says California, and it says the percentage. So please know that, like, you can take action. If you do this and you see that you're under withheld, you can call the payroll companies, and they'll work with you, I promise.
Okay. Okay, so another question is there anything that I need to know if I work a job in another country, like Canada, right? Or another country, but I'm an American. Is there anything I need to know when it comes time to file my taxes for the money that I earned in that other country?
Yeah. Well, you'll pay taxes on you probably know you'll pay taxes on your worldwide income.
Worldwide income.
For Canada, you, I mean, the way I'm reading the law now, essentially, you're supposed to do a Canadian return, right?
That's what I've been hearing.
I mean, essentially, we didn't used to do that. We used to just take the Canadian. We used to just take what's called the foreign tax credit for your taxes that were paid in Canada. But the way it seems now is that you actually have to do a Canadian return.
Also, yeah.
So because you have to see if you get the credit back. So when you're in Canada, they take out 23%, and if you're in one of the provinces, they may take out another 10%. So you may have 33% taken out of your paycheck. And in the past, we could just give you a foreign tax credit for that. But my understanding is now that you'll have to get a Canadian tax return done first, because they may actually refund you all of that money, and then you pay taxes on it in the U.S. Or they may refund you some of that money, so then your foreign tax credit should be based on that lowered amount, not the full amount that was taken out.
Okay, so I've gotten the 5-minute warning, and so I want to close with 2 quick questions, okay? The first one is, are there income thresholds that I have to reach to actually be considered a performing artist when I file my taxes?
As long as the way that I understand the rules, as long as you've established that you have made money in the business, you don't have to make anything to call yourself a performing artist.
Okay.
In other words, you can still take those deductions as long as you meet the criteria for actually pursue it, like that it's a legitimate pursuit for for work. It's not just a hobby.
It's not a hobby,
Yeah.
right? Okay.
And that's not the qualified performing artist, right?
No, no, no. And so I think though there's a misconception out there, right? Which is that, well, I can't take all of these deductions, which now obviously has changed, but because I haven't earned enough money as an artist. But it really is that you have to be able to demonstrate clearly that this is a legitimate business pursuit, right? Not
Right.
a hobby. Okay. The last question I want to ask you guys, because I think it's a good way to sort of wrap up, is what is the benefit of, and do I need to, why would I look for, first of all, not just doing my taxes on TurboTax, right? But then what is it that has me decide between a tax preparer, an enrolled agent, a CPA? Like there are all of these things out there. How do I know what I need?
Let me do it.
Well, I'll just say my thing, and then you
All
can
right,
say. I personally think you need to go with who you like working with. You want to make sure they're at least CTEC certified, right? But a CPA, EA, tax attorney, CTEC, I mean, I think if they're a competent tax preparer and, you know, when you're talking to them, you feel like they know their stuff and you feel comfortable coming to them with your, you know, tax needs, then I think you found the person that you should work with. But, you know, if they're doing stuff that you don't understand and you don't feel good about it, then I think you should move on.
Awesome. Thank you. And how about you, Ronnie?
That was well put. I would say the same thing, and I would look for someone who actually, depending on your ability, your need to know or your ability to know what's going on, I would look for someone who's willing to take enough time to explain to you what's going on.
And I love that, and I want to sort of echo that, right, guys? We have to know what's going on, right? It circles back to where I started, which is that nobody cares about your money more than you, okay? And so having a partner on your team who isn't willing to make sure that you understand what they're doing and why they're doing it, to me, that is not the partner that we want to have on our team. And sometimes we allow ourselves to be intimidated and we just do what I call park and pray, right? Which is we hand our money to someone and we hope and pray that they're doing good things with it. And I just don't think that that's the powerful way to move forward in terms of your finances as a creative and honestly as a human being. So I want to thank our two guests. If you guys will join me in helping to thank them.
Thank you, Miata.
And truly thank you to the SAG-AFTRA Foundation and to the Actors Fund for bringing this information to all of us. I hope it's been at least a little bit helpful, and have a great night, everybody.